It is almost 1 p.m. here in Sydney. Welcome to Bloomberg Markets Asia. I'm Stroud-Watts. Let's take you straight to Canberra, where, of course, the Chinese Premier Li Qiang is visiting Australia. This is really the first high-level Chinese leader to visit the country since 2017, in a culmination of how much the relationship between the two trading partners has really improved over the last couple of years. We've seen most major trade strikes already drop, namely those affecting things like the export of Australian wine. There are still a few in place, so we'll be seeing if they make it in terms of the deliverables and the announceables, I should say, after this meeting. We've seen already today that ceremonial welcoming of the Premier in Canberra with the military band playing the national anthem of China, as well as the signing of the guest book. And we're now looking at sort of pictures of the Great Hall in Canberra, continuing to watch this trip to see what is announced. We have already heard Prime Minister Albanese expected to talk about how the tensions between the two nations will not improve if they're left to fester. Let's take a look now at how markets are trading across Asia. We're just hitting about midday when it comes to many major markets that are trading today on this Monday morning. We have seen this kind of global sentiment pulling back to risk aversion. A lot of the political chaos in Europe, in France, and the UK elections coming up hasn't really been helping with that, and a lot of haven demand going back into things like the US dollar, which is still sitting a little bit high if you take a look at the Bloomberg dollar index there. Chinese stocks are on the way down, not getting much of a support given that we did have a mixed bag of Chinese economic data. Consumption was kind of the red bright spot. There are questions as to how sustainable that is given some seasonality and a holiday was at play there. We also saw the PBOC leaving their key rate unchanged on the back of currency pressure, and that was now the MLF rate being unchanged for a 10th straight month. So the calls for a rate cut and further easing measures, of course, have grown louder given the weakness in growth, but we haven't seen that just yet for the PBOC. Decidedly a down day, though, if you take a look at how the Nikkei has been trading as Japan is on that lunch break. The Kospi also a bit softer today as well. Let's take a look at some of the major events that we're following up at the beginning of this week. On the central bank front, Australia will probably keep rates unchanged on Tuesday. Sticky inflation remaining a concern. Hold also expected in Indonesia and in the UK. In Japan, inflation for May expected to tick up, perhaps giving the BOJ the green light that it's looking for to raise rates again. Let's get a closer look at the latest eco data out of China. We saw some misses in May in terms of the broader activity numbers. The focus also continues to be on the weakness that we see in the property sector. Home prices, in particular, posting that faster drop compared to the prior month, despite government efforts to support the sector. Let's bring in our Bloomberg economist, Eric Zhu, in Hong Kong. So, you know, Eric, at this point, what would constitute a green light for more easing, for a move from the PBOC? Because the data really isn't that good.
Yeah, I think it's kind of disappointment. We didn't see the PBOC pull the trigger today. I think now it's probably the anchor will be more following the Fed. So the next Fed move will be probably it will make PBOC more convenient to cut rates. But for now, at least I think the market expects Fed will not easing probably until the third quarter of the year. So we're also pushing back our expectation for the PBOC cut. And probably it also means this year's PBOC overall cut probably will be fewer than we had expected earlier.
Eric, when it comes to the property sector in particular and the fact that we continue to see weakness, I mean, this is a sector that's in structural decline, right? Can the government really do anything? And is this an issue of broader consumer sentiment and confidence just not being there?
Yeah, I think probably it's still early, to see the impact from the main new stimulus on the housing market. But overall speaking, I think the main housing data hasn't seen any, significant or improvement on the broad side. So I think now the government is changing some idea, as we have seen in May, they started a new scheme which trying to use government funds to purchase the inventory on the market. But the overall scale is still too small, and probably it's just starting, and we're not sure if the pace will pick up soon. But at least at this stage, we didn't see that the scheme has had a significant impact. So we would expect, the scheme to pick up the pace or to pick up scale. Only when that happens, we are going to expect some more impact on the market.
Retail sales was a beat. Do you expect this to be sustainable?
I don't think so, because probably even if we see a pickup in May, I think the overall growth rate is still kind of low if you compare with, before the pandemic, the normal trends. So, and don't forget, there's also a holiday boost in May, so that probably, temporarily lifted the figures. I think overall, the consumption will still depend on people's expectation, on their jobs, on their income growth in the future, and that doesn't look very bright right now. So we still think retail sales or consumption probably will face more downside than upside risks.
Yeah, and is the key to boosting animal spirits, if you will, really solving the issues in the property sector?
I think expectation is still the key, and the market sentiment and consumer sentiment, how do they expect the market to change in the future? I think that's a key issue right now. Even if you have more easing, on the home buying, on the mortgage rates, we don't think that will, change the picture until consumers really think their future expectation will be changed from what we see right now.
Bloomberg economist Alex Zhu there in Hong Kong. Let's get some analysis on implications for investors. Joining us now is Vikas Prashad, who's the Asian Equities Portfolio Manager at M&G Investments. Vikas, great to have you with us. So if you take a look at the data today, does it sort of change your positioning when it comes to whether or not you want more or less exposure to Chinese assets?
Good morning, Heidi. The data don't really change our view. In the early part of this year, China was the one market to which we allocated much more capital than other markets across the region, except for Japan, and we maintain that positioning now. There are some sectors where we have been less constructive for several years now, and that does not change. Banks is one. The property sector is another. Mega cap Chinese tech is another. But there are plenty of opportunities that we are looking at and spending time on, including the factory automation sectors, the automotive sector, broadly defined, the consumer sector. If you look at some of the recent transcripts from Western companies, Starbucks is one example. They're highlighting the fact that they're losing some market share to local Chinese companies that are more tech savvy, that understand their customers better. And that's where we're spending our time. One last area is, if you look quietly, the IPO activity in Greater China is picking up again after a long time. It's not quite to the level of activity that we're seeing in Japan, and certainly not to the level of activity we're seeing in the IPO market in India. But it's nice to see that companies are beginning to list again. Chinese companies are beginning to list again. They might not all list in Asia, as we know. There's a big one potentially coming in the UK. But there's plenty to look at in China.
More broadly, we've seen a lot of downside pressure on Chinese equities again, right? It seems like bad headline after bad headline. Do you expect this kind of to be a bit of a downward spiral? Do you think that this is a rally that will find momentum again?
I don't think that this is a downward spiral. Our team doesn't view that either. I can understand why many investors have this view that Chinese market is one for relative performance, not absolute performance. Contrast perhaps with India, which is seen as a market of absolute performance, but relative performance is hard. We don't share that view on either market. If you look in China, there have been many absolute winners over the last 6 to 12 months and over the last few years. And we continue to think that the market will find many of these names again.
In terms of the consumer sort of brand names, domestic consumer names that you like, can you give us a few sort of tradable ideas?
Sure. In the F&B sector, for one, in the logistics space for another, there are companies that are local, homegrown, that are incorporating technology much more quickly than foreign competitors. I mentioned peers of Starbucks as one, but if you look across the F&B space, across the QSR spaces as well, then you see a lot of local companies taking share and growing in what is a challenging market for consumer spending. They actually are growing. They're growing their footprints, they're growing revenues, they're growing profits. I think those are two places where investors can start to look.
When you talk about China tech, obviously there's a lot of geopolitical implications that are risks there, right? What are some interesting plays to you that perhaps can sidestep some of those concerns?
Well, the semiconductor supply chain is an obvious place to look, and the restrictions being placed on Chinese companies by the West are creating some issues, raising some hurdles in the short term, but they're also forcing innovation. And we see that in the semiconductor supply chain, in the auto semi supply chain in particular. But then if we look at the factory automation sector in robotics, the incorporation of AI into robotics, many of the companies that we see in China are world leaders in that space. Some are still private, but some are now coming public. There are other companies that supply to those companies that are private. So there's plenty to look at in those spaces as well. One area where we have been spending less time this year than perhaps 2 years ago in that broadly defined auto supply chain is the battery space. That space seems to have become a little bit more challenging to us. So we have reduced the allocation of time and capital to that subsector.
Chinese Premier Li Qiang is in Australia at the moment on his 4-day trip, and that relationship is on better footing than it has been in a very long time. But we know how fragile these sort of bilateral relationships can be, right? Are markets discounting some of the geopolitical risk as we get into November, for example? Not to mention everything that's going on in France at the moment and going into the UK elections.
I think we all anticipated this as 2023 turned into 2024. This was always going to be a big year of elections and a big year for the impact of elections on markets. And we've seen that from India to Europe just this month. And I think that will continue heading into November. One thing worth remembering is that from 2017 to 2021, when President Trump was in office, there was a lot of noise around the impact on China and on America of the restrictions being placed on Chinese companies. Since 2021, it seems to us that President Biden's administration has been even more punitive on Chinese companies. And so the question of what happens if there is a change in the White House next January, I think you're already seeing a lot of restrictions being placed on Chinese companies. Could they be tightened? Perhaps. But they're already pretty punitive. So I think the markets have been discounting that for a while. Now, what's happening in Europe, we're less close to that than what is happening in Asia. But as you've seen in India 2 weeks ago, a market that rallied was then down 9% intraday one day is now up since the election results were out. The markets will digest these. But it's a fair question. We spend more time scenario planning around geopolitics than we do around any particular level of interest rates or inflation assumptions. This is something that we spend more time around.
Do you invest around Chinese EVs? You mentioned batteries a little bit earlier, but is that a thematic that interests you? I mean, we know that there's a $3 billion EU tariff hit, for example, but is the sort of rhetoric around overcapacity for these sectors in China just that, and there actually are opportunities around them?
There are opportunities. There are only so many opportunities we can look at the same time. I would think that, or I would posit that the returns on capital in this sector have fallen. So the returns on our time allocated to the sector have also fallen. This race hasn't been won yet. I think 3 or 4 years ago, there's a view that many of the North Asian and Chinese companies in particular had won the energy storage space for vehicles. But when we look at the technologies coming up in the US and in Japan and in South Korea, it still seems early. It still seems that there's more uncertainty than we're willing to digest or take on. And so we're spending our time elsewhere.
Vickers, do stay with us. Vickers Prashad, who's the Asian Equities Portfolio Manager at M&G Investment, is staying along with us to talk about some of the other markets. Still ahead this hour, we'll be speaking to the CEO of global data and internet provider Tata Communications about their growth strategy and the outlook in India and elsewhere. Don't miss our exclusive interview coming up. This is Bloomberg. take a look at how we're trading. It has been a pretty muted session this Monday. Of course, we've got another couple of key markets that are not trading today, including India. We've got Japan on the lunch break at the moment, but it has been a pretty downward session there so far. Hong Kong stocks, though, adding about 0.4%. We're seeing the Kospi a little bit softer today, and Taiwan just sort of treading water there. Sydney stocks not really moving much in much of a direction today as we continue to watch the Chinese Premier's visit to Australia and what potential announceables and deliverables might come from it. Let's bring back for analysis Vikas Prashad, who's the Asian Equities Portfolio Manager at M&G Investments. So I want us to start with you on Japan. How much further do you think there is in terms of this rally and this opportunity, given that perhaps some of the cyclical headwinds, the currency advantage, for example, may have started to fade?
Our view is that it's still early in the innings for this equity appreciation cycle for Japan. Now, why is that? Number one, the corporate governance reforms that have started to take root in Japan have still not spread to every sector, every market cap band. That will continue. Earnings growth is set to continue at a broader market level in the high single digits, we think. Buybacks will continue. Treasury share cancellations will continue and dividends will go higher. You put that all together, so there's a case to make that Japanese equities will return over 10% per year for the next few years. And there are pockets of growth that are much higher than that on the earnings side. There are pockets of growth where the companies are even accelerating even more their pace of buybacks, treasury share cancellations, and dividend increases. And so it's still pretty early for Japan. If we look at the FX, earlier we were talking about geopolitics, interest rates, inflation. The FX rate, the dollar-yen cross, is something that we spend less and less time thinking about with every passing year, because what we've realized is that the best companies in each sector treat this as business as usual. They'll figure out a way to manage it. We keep an eye on it. We model the impact of various levels of the yen against the dollar, against earnings estimates, but it's not really driving our thesis.
And the reality is that some of these sectors are quite stretched, right? Semiconductors and semiconductor-related names, for example. So do you kind of hit pause on those and look for opportunities elsewhere? If so, where?
Absolutely. We were perhaps a little bit early in reducing our exposure to the SPE sector in Japan. That rally has continued, or it did continue for a while, beyond our expectations. The valuations went from being pricey to expensive to quite stretched in some of the names. And that's where we reduced our exposure. The good thing about Japan is you have thousands of listed companies, and small caps to large caps to mega caps all are throwing up our interesting opportunities on a long-term view for us. And so we continue to spend a lot of time on Japan. If you look across all of our strategies, Japan is the largest single country allocation that we have, and that continues. We maintain that. There's a lot of interesting opportunities. The engagement opportunities with Japanese companies continue to increase, and the focus of Japanese companies on sustainability, depending on the sector, depending on the size of the company, it varies from improved disclosures, increased board independence, increased diversity, reduced carbon footprint. But all of that is increasing as well. So there's a lot to do in Japan, and we remain very excited about that market.
And adjacently for South Korea, you say that the Value Up program and the proposition is real. We know that a lot of people are hoping for the same degree of success that we see in Japan, but that took 10 years. So is now the time to be investing in South Korea?
Even without the Value Up program, it would be the time to start investing in South Korea, or if you are already invested in South Korea, to increase your exposure to the companies in that market. And it's not just a semiconductor market like Taiwan, it's a broad and deep market. There are interesting auto companies, there are interesting consumer companies. Not unlike China, the large cap tech sector, consumer tech sector is something that is less interesting to us, and much less interesting to us today than it was a couple of years ago. But there's plenty to look at in South Korea. Now, on top of that, you layer the Value Up program. We think that there are many reasons that this should work and needs to work for South Korea over the next few years. And that adds another layer, another level for the equity markets to tap into for returns over the next few years.
I wanted to ask about India. We've seen the Nifty 50, for example, basically almost entirely recover from what we saw last week, right? Does that mean volatility's also come down as well? Does that mean that the investor certainly still believes, even post-election, that the reform agenda and the growth agenda remains very much intact?
I think the volatility that we were going to see post-elections in India, we did see 2 weeks ago on the Tuesday after the election results started to come in. I think the investors have realized, the market has realized, and the governing coalitions have assured the investor community through its actions that in India it's business as usual, that some of the faces might change, but the direction and the country is in, the path that the country is on, that is pretty clear. And we're not going back. Some reforms might take longer. Some reforms might be accelerated, depending on the sector. Defense spending might be curtailed a little bit, although the recovery in that sector and the share prices would not suggest that. And the spending for some of the consumers, sectors facing rural consumers might be accelerated, but we'll see. But in general, India is on a good path. It's a market that continues to be pricey, but that's where the growth is. And there are a lot of themes that investors can invest in now that even 2 or 3 years ago they could not. Machine tool companies, there have been IPOs in that space. People who follow Japan have a lot of IP that they can now leverage in India. There's the data center space. I will be tuned in to your session with the Tata Communications CEO later this morning. I want to hear what they're saying about data centers and the build out of the country's data infrastructure. And there are many ways for investors to invest in that. And that's not it. You're seeing a very large South Korean IPO business listing in India. Who would have thought that would happen a couple of years ago? That will be a very large IPO. There's a lot of excitement about that in India. I presume there's a lot of excitement about that in South Korea as well. There should be. So that will not be, based on what we hear, that will not be the last IPO of a large foreign company listing in India this year, next year. I think that trend will continue.
Because really great to have you with us, Vikas Prasad, Asian Equities Portfolio Manager at M&G Investments. Much more ahead. This is Bloomberg. Take a look at some of the sectors and the names that we're watching in the trading session just about halfway through here. China properties are deeply in the red there. Shimal property down by almost 6% there. We're also seeing Agile property off by 5.5% there as well. We saw home prices for China falling at that faster pace in May. Even the most forceful efforts to date from policymakers to support the market still not really taking effect at this point to revive demand or confidence. We saw new home prices across those 70 cities survey, excluding state-subsidised housing, falling about 0.7% in April. That's the most since October 2014. So that property situation continues to languish there, and that obviously has fed through to a lack of confidence in other parts of this market as well. A good news story, though, when it comes to one stock that's trading quite nicely at the moment. 5.5% or 5.25% higher is Hyundai Motor, looking like a record high. The India unit filing for the IPO said to be one of India's largest listings ever if the numbers come through. Hyundai will be collecting all the proceeds from that IPO of its local unit. They're looking to raise about $2.5 billion in the IPO, that potential listing plan by the end of the year, according to something that we sort of reported a little bit earlier. Taking a look elsewhere when it comes to what's trading, and it is a pretty risk-averse session, I will say. A lot of geopolitics on the mind when it comes to the uncertainties in France, of course, the upcoming UK election there as well, and a lot of sort of repricing of Fed expectations there. Still ahead, China or Australia agreeing to build on warming relations. Premier Li Qiang meeting with PM Albanese. This is Bloomberg. Welcome back. China markets just headed out to lunch and, not much to celebrate when it comes to Chinese equities or sentiment. That consumption number, though, retail sales that came through in the data dump was a rare bright spot. Whether it can be sustained or not is a big question mark, but we see weakness across just about every other economic indicator, including, worryingly, that big fall when it comes to new home sales prices there as well, despite, of course, some of these pretty desperate measures that we've seen from policymakers. The PBOC, though, are staying on hold with that MLF rate, and against really ever louder calls that we could potentially see, or should potentially see, more easing from the central bank in China. Taking a look at equities, we are seeing the CSI 300 off by about 0.25% there. The Shanghai Comp down by about 0.5% there as well. Property stocks in particular seeing steeper declines, as we saw home prices decline even faster in May there. So that gauge for Bloomberg Intelligence of Chinese developer stocks down by about 2.5%. We saw some of the biggest losers off by as much as 6% in the session. Dollar China looking pretty much unchanged, but we have seen quite a bit of greenback strength as a bit of haven demand returning there with some of the geopolitical concerns. Taking a look at what else we're watching when it comes to markets that are trading around the region. Japan has seen a bit of weakness today as well, down by just about 1.9% there as well. We had the core machine orders falling almost 3% month on month, and really continuing to add to perhaps some of the uncertainty as to what the Bank of Japan's trajectory will be going forward. Of course, that sort of assessment from Bloomberg Intelligence, at least, looking towards July as a live meeting when it comes to bond purchases, as well as on rates as well. The topic's also seeing quite a bit of softness. Dollar yen trading at 157.45, and we are watching bond markets around the world as well. Interestingly, we've had really treasury traders looking a little bit more towards the data and less towards the communication from the Fed. Japanese automakers is one that we're watching. We were looking at Hyundai a little bit earlier, and the fact that we've had this big move when it comes to Hyundai, but some of these other regional automakers, and not so much, the likes of Toyota down by 2.5% there. Some of those safely regulatory woes continuing to play out. Toyota certification issues seen as breaching UN rules, according to reporting in Yomiuri. Australian Prime Minister Anthony Albanese and Chinese Premier Li Qiang have agreed to renew dialogue and strengthen cooperation between the two nations.
Without dialogue, we can't address any of the differences that arise between us. Australia and China have renewed and revitalised our engagement.
All right, let's bring in Bloomberg's Paul Allen, who joins us from a freezing Canberra. And Paul, I'm hoping that the meeting, at least from the outset, looked a lot warmer.
Yeah, that's right. It was a very successful meeting. Li Qiang and Prime Minister Anthony Albanese probably wrapping up their lunch around about now. But a number of bilateral arrangements were signed as well on the back of those joint remarks. There was a memorandum of understanding on strengthening the free trade agreement between the two countries. Also an agreement to resume cooperation on climate change, and there will be some ministerial dialogue later in the year about that. Also an MOU in terms of education and cooperation on research, and of course Chinese students, a tremendously valuable export for Australia, earning about $11 billion in 2023, and China's also going to include Australia in its visa waiver program. So a number of symbolic and important milestones were signed there. Anthony Albanese saying that this reflects the broad range of areas where we can cooperate. Premier Li said earlier that this relationship is back on track, although there are still plenty of challenges to discuss. The Prime Minister said that he would not hesitate to raise those. Those include some of those near misses between the two militaries that have been occurring. There is, of course, the fate of the writer Yang Hengjun, a dual Chinese-Australian national who is still in detention in China on a suspended death sentence. So still plenty of areas of disagreement for the two countries to have dialogue on.
And one of those contentious areas might be strategic minerals, right? Is that next in terms of this 4-day trip for Premier Li?
Yeah, definitely. Premier Li will be heading to Perth next. He'll be visiting a lithium mine there, also Fortescue's hydrogen project. But yes, China very interested in investing more in Australian critical minerals. And of course, Australia has a vast repository of rare earths. However, it was only a few weeks ago that Northern Minerals was ordered by the Australian government to have its Chinese investors divest their holdings in that company in the national interest. So this is still an area where there is a point of tension. Another area where there's a point of tension is the few remaining trade strikes. There's a couple of beef abattoirs that are still on the prohibited list. Live lobsters can no longer be exported. But considering Li is heading to Western Australia, which is where a lot lot of the live lobster exports happen from. We are anticipating, if not an announcement while Premier Lee is here, that perhaps in the next couple of days that last remaining trade strike could be lifted.
Bloomberg's Paul Allen there in Canberra. Well, staying on geopolitics, and South Korea says sharing any nuclear technology is its red line for cooperation between the North and Russia. President Vladimir Putin is set to make his first trip to North Korea in 24 years this week. South Korea's Defense Minister Shin Won-sik spoke exclusively to Bloomberg in Seoul about what he thinks Putin will try to get from Pyongyang.
푸틴이 원하는 건 포탄이겠죠. 미사일하고.
What Putin wants would be artillery shells and missiles. Putin is expected to seek closer security cooperation with North Korea, especially military supplies such as artillery shells that are necessary to seize a chance to win.
물품에 대해서 북한에게 요청하리라고 봅니다.
In terms of the satellite, we saw North Korea's last satellite launch fail, and that's despite Russia's pledge for cooperation, space cooperation. So what's your take on that?
그게 바로 러시아의 엔진 최신의
They are exactly Russia's latest engine technologies. So our assessment is that North Korea has admitted to receiving engine technologies from Russia. In terms of why they failed, they have yet to secure reliability as they integrate North Korean engines and other technologies that they have developed with Russian technologies. North Korea is believed to be continuing engine tests at the moment, and we believe that they will try another launch in the second half.
할 것으로 시험 발사가 아닌 발사를 할 것으로 저희들이 생각하고 있습니다.
How much North Korea is spending on launching these missiles from short range to intermediate range and ICBM? Do you have a breakdown?
개개의 발
Rather than speaking of the cost of individual missiles, let me give you an overall figure. North Korea fired around 30 missiles last year. According to a thorough estimate from the Korean Institute for Defense Analysis, known as KEDA, we would need some $1 billion in spending. The money is enough to cover North Korea's food shortages for a year. So in fact, North Korea is ignoring its people's hardships to carry out missile provocations.
So, Minister, Russia helping North Korea's military technology, that inevitably means greater threat for South Korea. So what is your red line in terms of Moscow's military cooperation with North Korea?
아까 말씀한
We consider the transfer of key technologies related to nuclear and missile programs as the red line, but it's something that needs to be decided together by South Korea and the US. There's no point in the South Korean government setting it alone. So we are having discussions to decide with the US and share with like-minded countries.
We're hearing that there could be another three-way summit between South Korea, US, and Japan. So in terms of the security cooperation, what is the priority for South Korea?
우선 북핵 미사일 위협에 대응하는 데 있어서
A priority would be to establish a system to more effectively, promptly, and coherently respond to North Korea's nuclear and missile threats among South Korea, the US, and Japan, and to make that irreversible. So during the last Shangri-La dialogue, we have decided to create a security cooperation framework amongst the three of us. South Korea has drafted a document and proposed to the US and Japan. The defense ministers of the three countries will sign it in the second half of this year.
한미일 국방부장에 서명하기로 했습니다.
Minister, China has accused the US of trying to build what it calls an Asian version of NATO. So what are your thoughts on that?
중국이
On China's concerns, I think it really depends on China's behavior. If all the countries in the Indo-Pacific, not just China, adhere to the rules-based world order, the rest of the world will not try to limit it. So the idea of an Asian version of NATO to me seems like a premature concern. But at the same time, I believe that the best way to dispel such concern is for China to give the Indo-Pacific region and the international community confidence that it will uphold the rules-based international order, and there should be no problem.
지킨다고 하는 확실한 믿음과 신뢰를 인태 지역 나아가서 국제사회에 준다면 아무 문제가 없다고 생각합니다.
South Korean Defence Minister Shin Won-sik there speaking with Bloomberg Soo-hyang Choi. Coming up next, we speak to the CEO of global data and internet provider Tata Communications about the growth strategy and outlook in India and elsewhere. That exclusive conversation is next. This is Bloomberg. Well, India's wanted IT and communications giants have been facing a reality check as global investors rush into the artificial intelligence theme. Tata Communications last year announced a tie-up with NVIDIA to develop an AI cloud product. Let's get an update on that venture and the company's other strategies for growth and innovation. Joining us exclusively from Mumbai is the Tata Communications CEO and Managing Director, AS, Lakshmi Narayanan. Lakshmi, really great to have you with us. And, we do really want to know about the tie-up with NVIDIA. Can you give us an update on how that's going and some of the growth and value opportunities that you derive from that?
Yeah, hi, Heidi. Very pleased to be here with you. Tata Communications, we announced first of all our digital fabric, and it's got 4 components. One of the components is the cloud and the security fabric, and we already have a private cloud. We announced an edge product, and we have a great security offerings for the network and others. And as part of this unit, we announced our partnership with NVIDIA to extend our cloud into delivering AI cloud to fulfill the AI mission of the government of India, supporting the government, supporting the startups, and supporting the enterprises here. So this partnership with NVIDIA will allow us to launch a state-of-the-art product which can deliver the best price performance for companies that wish to train the models, the companies who would want to deliver inferencing and deliver all the value to their consumers.
How compelling is the technology of AI, or I suppose how crucial is it for a company like Tata Communications to be able to empower it in terms of the broader slowdown that we're seeing across the industry?
I think the slowdown is because of various factors, but I must add, last year we did deliver close to 20% data growth despite all the macro conditions. So we had done that on the back of a lot of investments that we have done in the international geographies particularly, and also strengthening our product portfolio across the digital fabric. And as I said, as part of this fabric, we intend to solve very crucial problems for our customers who are moving to internet, who are moving to cloud. The whole digital infrastructure has become quite complicated for them to manage and to be able to deliver a better experience of people who are using applications on the cloud. So our digital fabric solves that problem. And as part of that, AI is becoming crucial. While there is a lot of, hype on Gen AI, today Gen AI, bulk of the money is made on the infrastructure side. Gradually, people would want to build applications that are of industrial scale. So today, most enterprises are doing POCs, and they would graduate to make it more at industrial strength. And that is when we would see a lot more take-up on the enterprise side. And we are having to make sure that we are well prepared. We have trained our workforce. As I said, we are launching our AI cloud to prepare ourselves and the enterprise world for the upcoming AI boom, shall I say. Yeah.
I do wonder, what sort of strategies are you banking on to try and increase data revenue in the face of potentially what could be a looming slowdown?
I think we have been preparing ourselves. Let me explain the concept of a digital fabric, which is essentially a complete digital infrastructure for enterprises. And our fabric consists of 4 components: a network fabric, a cloud and security fabric, an interaction fabric, and an IoT fabric. And if I look at enterprises today, managing all of these have become quite complicated. They are moving to internet, they are moving to cloud. There's quite a lot of technologies and it's becoming quite complex for them to manage all of these in a secure fashion. And secondly, while people have added on these technologies and moved to cloud, the delivering the right user experience has also become a problem. So what we have done in each of the fabrics is to essentially help enterprises to really uncomplicate things for them, manage all of these in an end-to-end fashion in a very secure fashion. And that delivers them a tremendous amount of cost benefit. And also we can show them that it delivers a lot more better user experience. And there are examples where we are also showcasing where this would also help them to reduce their carbon emissions. So if I look at our network fabric, one example that we like to talk about is in our media segment. As you know, today the ICC T20 matches are going on in the US and the Caribbean. We do Formula 1, we do Formula E. So for many of these players, what we have done now is enable the remote production. And because we are enabling remote production through the technology and services that we offer, they are saving not only money, avoiding crews traveling from one race to another, but it also helps them to reduce their carbon emissions. So Formula 1, for example, has stated that they want to reduce their carbon emission by 30%, and we are part of the journey with them, transforming the technologies that will help them to deliver all of these things. So our mission is to uncomplicate things for enterprises, make them more secure, deliver better application experience for customers, and also along the way help them to reduce their emissions. So we have a great proposition. And this is what is resonating with our customers, and this is what we believe will help us to grow.
Yeah, and in terms of that growth, do you aim to grow through overseas acquisitions, and what major markets would you be focusing on?
Just last year, our international revenues became 54%, so we were close to 50-50 between India and international. Last year, international revenues were at 54%. And we did acquire Switch, which is a US-based company which delivers several great media products for streaming companies and other media houses, delivering football and other sporting events in the US. And that acquisition has helped us not just get us a better footprint in the US, but also helped us to enhance our product offerings in the production space. We were not in the production space, and with the Switch acquisition, we are now having a great capability to deliver production remotely and from the cloud as well. Similarly, we acquired in our interaction fabric, we strengthened the fabric through the acquisition of Kalera, which was a US listed entity, which we now completely integrated into Tata Communications. And Kalera, as part of an interaction fabric, aims to help our B2C enterprise customers to deliver great contextual and converged experiences of how these companies interact with their consumers. So if you see, all of us receive SMS campaigns from many players, marketing campaigns, several unwanted calls, people interact through WhatsApp, and there are multiple other channels that consumers interact with various brands. And our effort in our interaction fabric is to converge all of these interactions and make them more intelligent as well, so that the enterprises can be more sharper in how they are interacting with their consumers and deliver more effective, not just cost effective, but even deliver a better experience for them. So that's another acquisition that we did. So these are two major acquisitions that we've done in the last year.
I do have a question about the company's debt. Is that of any sort of level of concern?
No, it's temporary. It's part of the strategy. Heidi, the company, we had 5 years ago, when we saw the company, it was very different. Today, our balance sheet is very strong. Profitability is quite good. We reduced our overall debt levels. But for the company to grow, we had to make investments. So it was part of our strategy that we announced last year, that we are going to be investing in new products, new capabilities. We're going to be investing in markets, especially international, where we had to strengthen our sales and marketing, so we've invested quite heavily in that. And these investments have translated into slightly increased level of debt this year, but that was very much part of our strategy. And we have announced that in the medium term, we would decrease the debt levels and improve our cash flow. That is what our strategy is. So we are not really concerned about the present debt levels.
Double-digit growth, record share price. I think it's up over 700% over the past 4 years. What could go wrong? What are the biggest risks for you right now?
I think obviously the macro conditions. So we have, several challenges, the geopolitical risks and elections looming in many countries. So obviously this means that the decision making in the enterprises are slower. That is one. Secondly, we are positioning to really disrupt in the international market. We believe we are very unique with our digital fabric concept. And we are a disruptor. We're going to be a challenger in the markets. So therefore, when you are, we have to make some very bold moves and very bold bets, especially in the infrastructure side. The old adage of if it ain't broken, don't fix it is one that still persists. We believe the enterprises are realizing that having a legacy infrastructure while they move everything else to the cloud is not going to get them where they need to be, especially in the new AI world. So we believe the change will happen, and with that change, we will be very well positioned to help our customers.
Really great to have you with us, and we appreciate your time. A.S. Lakshminarayanan, who's the Managing Director and CEO at Tata Communications. And we take you back to Canberra as we continue to follow Chinese Premier Li Qiang's visit to Australia. This is the first visit by a high-level Beijing leader since 2017, and really a combination of how much that relationship between Canberra and Beijing has improved over the past few years. Prime Minister Albanese there spoken earlier about how more communication, better to deal directly with each other. Much more to come. This is Bloomberg. Take a look at some pretty lackluster markets that we're seeing trading around the region. But, of course, the China activity data did not help, really. The only bright spot was retail sales. As you can see, there was a beat on that 3% estimate, but still with a prolonged holiday during that period, there are questions as to whether that's a sustainable uptrend for consumption. Industrial production, factory activity, fixed asset investment, those readings really missing expectations, as well as that slump that we continue to see in home prices was perhaps most worrisome for the markets. New home values remain dropping the most in almost a decade, despite these most forceful efforts yet to support home sector growth hasn't revived demand. That is it for
Good Monday to all our viewers. It's noon here in Hong Kong. Welcome to Bloomberg Markets Asia. I'm David Ingles. Let's get to your top stories today. Stocks across the Asia-Pacific down as concern over the French political crisis stokes anxiety in global markets, while traders await policy decisions from major central banks this week. Now, a mixed data picture out of China, with retail spending beating forecasts, but more gloomy news across most other metrics like factory output and especially on property prices. Plus, the next movie featuring Disney's foul-mouthed anti-hero Deadpool cleared for release in China in a big boost for its revenue prospects. All right, that's the big show coming up. We have a big one, too, coming up over the next 60 minutes or so. Welcome to the program. Hope you're all well. We'll just get you started, catching up you all, getting you all caught up with the market action. And just keep in mind, though, as far as volumes, so on price, you look at a market like Japan, down the most in almost 2 months. Volumes that are about 30% lighter than usual for this time of the day. We have at least 8 markets in the region shut today, so just bear that in mind. Across sector groups as well, nothing much to glean as far as consistency is concerned. It's really a risk aversion play, with the exception of Hong Kong, which went into the lunch break. More on that in a moment. But as you can see, A50 futures on your screens too. About a 0.2% to the upside. We're also looking at what's happening over in Europe. especially. So last week, in case the small chance that you missed it, the biggest blowout in the yield spread between where you are on, French 10-year bonds and bond yields and German 10-year bond yields. And it's not just France, right? You did see a pickup as well in widening as far as similar measures as far as Italy is concerned as well. For today, still some declines across bond futures, although you are getting a pickup in European equity futures. Of note, though, the CAC index was down over 6% last week, so we'll see what happens, of course, going into today. Have a look at the currency markets, and as you read all the news in Europe, of course, the euro's just begun, so that's a separate conversation. Maybe you can talk about that later if we have time. For a look, though, at what else we're tracking this week across these markets, so everything from data, you have CPI out of Japan towards the end of this week. You have a rate decision out of the Bank of England. Elections, of course, looming large as well there. So keep that in mind. Most are expected to hold, including the RBA, by the way, which is tomorrow. And trade numbers coming through out of Japan mid-week. Right. Now, as far as the data today is concerned, it's been extremely busy, by the way, these last 3 hours or so. So we'll start things off with activity numbers out of China. Most metrics missed, with the exception of a few like retail sales. 3.7% came in near the top end of forecasts. Although other metrics, industrial production, fixed asset investments, and just to underscore this, the National Bureau of Statistics talking about how effective demand still remains insufficient at this point in time. We're coming off a data release on Friday, in case you missed that, on credit numbers, and new credit numbers wanting still. So again, a drop in things like continued deceleration in things like M1, M2. New loans did come in as well, very, very weak, which takes us into, I would say, maybe the more critical set of numbers today, which is in the property market, right? So on price, 70 cities, 12 straight months, 0.7% month-on-month drop across 70 cities, which would be, on price alone, the biggest drop going back about 10 years. You have to go back to October 2014 for that. In terms of market breadth, 67 out of the 70 cities actually saw a drop in home prices year on year. So in terms of market breadth, the number of red on your screens is the most in about 9 years or so. So things haven't quite responded just yet to the series of measures and policy pronouncements that have been announced in the last 2 months or so. Let's bring in Eric Drew, our Bloomberg economist, with us here on set to talk us through your initial reaction. And we can start with whatever you want, property or activity numbers.
Probably activity number, I think the overall picture is still weak, right? Even if you see some upside surprise in retail sales, but it's still a weak number, right? 3 point something, so it's not a good number, right? So overall, I think the activity picture tells us that the economy is even decelerating, so from the first quarter, right? It's remind us a similar story last year, right? After a very strong first quarter reading, and from second quarter, you see the economy starting to, slide down, right?
Yeah.
So we worry about whether we're going to repeat that thing this year, and it's some signs of worrying because the policy side, people hasn't cut rate yet, right? This morning, they're still holding the rate. So probably looking from the data, it can be a policy mistake or a policy delay. So they should, doing more aggressive easing, trying to at least boost the market sentiment. And especially for the property market, we see the overall data. It's not deteriorating from last month, but it's not really improving either, right? Probably it's still too early to see the main stimulus for the housing market. Are they going to work? It's too early to tell. But still, at least we can conclude that the conventional, those measures, losing home purchase rules, lower mortgage rates, it's not really working, right? So that's why the government is trying a new scheme. They try to buy
the inventory.
Yeah. But still, it's too early. The scale is still very small, and the pace is, I don't know whether it's picking up or not, but so far we haven't seen, it's really boosting the market. But we need to still wait for a couple of months to see if they have really can change the game.
It is worth, you're right, it's worth keeping in mind that most of the major cities did start to relax most of the major measures on property only. I think it was May, if I'm not mistaken.
Yeah, middle of May, yeah.
So it's going to take some time here.
Yeah.
Taken together, though, so the loosening of property restrictions, number one, and some of the measures that are taking place on the supply side to sort of bring down the inventory. When do you think we'll start to see that show up in the data? And what data are we looking at specifically?
I think it's the most direct measure would be housing price, home sales, right? Those more reflecting the demand if there's really revival in the housing demand. But I think it really depends on the size of the new program and the pace of its implementation. We won't expect that you see, a miracle rebound instantly. It will take some time. Right.
The export side has held up quite well. In fact, when you look at global PMIs as well, seem to indicate that is one driver of activity that is reliable at this point, or dependable at this point in time. Do you think that bright spot continues, and does that then hold back policy support from other measures? Because we're effectively at the growth target anyway, the current run rate.
Yeah, it's helping the economy right away, I would say, but we're not sure if it's sustainable or not, right? Even if it's sustainable, we don't think it will be, strong enough to carry on China economy, right? Because the property drag is still too big. I think another bright spot, according to a government report today, is the high tech, those new economy stuff.
That's right.
The investment in industrial production, that's still very strongly, growing. But as our analysis has shown that still, if you add up all those together, it's probably still not big enough right now, at least for now, to counter the very sizable property drag. So I think that's property is still the key downside thing here. And
is the solution still lower rates? Because you mentioned, like on MLF, for example, they didn't move. You guys expected a move, but how much can 10 basis points help? Is
I think in terms of macro impact, it's not going to help much. Right? Okay. Even triple-R lowering interest rates, but we would expect the movement will be more on the sentiment side. So it's telling the market, telling the consumer that the government is really willing, to do something, right, to boost the economy.
Eric, fantastic. Thank you so much. Eric Zhu there on all the latest out of China. And by the way, it's been an extremely busy morning on the China story today. Just ahead here in shows, we look into the devastating impact of this oil spill that's actually spread, that's taking place in Singapore. If you've seen some of the pictures on social media, quite something over the weekend. More on that story in a moment. Plus, of course, everything else that's taking place across these markets this Monday. And we look ahead to the rest of this week and the second half. Plenty more ahead. This is Bloomberg.
We're going to get to 2%, I'm telling you. That is what we're going to do. And if you look at the last month, we did it. But that's what we got to do. And we are going to do it.
It's going to take some time to get inflation back to 2% all the way back. So my projection is that we probably won't get there until 2026, but we'll see progress continue in my modal view. And that's enough, right, to then say, okay, it's time to start the process of bringing rates down.
Fed officials there, or the latest Fed speak to on what the current narrative is around inflation. We are headed to 2%. We'll get there at some point. In the meantime, though, what do we do with that information? Joining us now is Junbei Liu, portfolio manager at Tribeca Investment Partners. Junbei, pleasure to have you on the show. Equity markets tend to rally going into monetary policy easing cycles. Is what we're seeing this year it? Is that it? And what now?
Yeah, absolutely. Thank you for having me. Look, we are seeing it now. In the last 6 months, the share market has been doing really, really well, aside from, obviously the AI thematic. We've got the interest rate certainly heading downwards. But look at our view is that whether the rate cut is this year for Fed this year or early next year, regardless, it is a rate cut. So that will be very conducive for the equity market. Remember, equity market always look forward. 6 to 12 months. So, we're well within that reach when the first rate cut will take place. Earlier on, then you talked to earlier in the program talking about targeting 2% inflation and the like. I do think that it might take a little bit longer. However, as we have seen with some central banks around the world, that the rate cut will take place whether the inflation get there quick enough or not.
Okay, then that then brings up the what then leads the equity market further from this point, because so far AI has taken not all but the bulk of the gains. Do I expect a broadening in this equity market rally, or do we lean further into this AI trade?
Absolutely. Look, it is a little bit tactical at the moment. I think the AI trade will continue its momentum simply because that technology is now being adopted and utilized in real life applications across almost every sector. So we do think the demand is enormous, and you do want to play with that thematic, not just in the chip maker, you further into the software, into the utilities, and into many other industries where you can generate return. I do think they will continue to drive quite a lot of the return for the market. But in the next 6 months, we are going to see a little bit of slowing of cyclical earnings. So economy is slowing down, and quite rightly. So we will see a bit of a soft patch across the earnings. So, we do see a little bit of weakness across cyclical companies. Your consumer-oriented companies might be a little bit weaker as the earning gets a little bit softer. But if anything, that they should be used as a buying opportunity, because as we head into the rate cuts, whether late this year or early next year, these companies and sectors, cyclical sectors, will rally aggressively.
Right. So correct me if I'm wrong. What you're saying is you put all that together. So by virtue, say, of index composition or sector composition, it seems that the U.S. Will be the dominant equity play in town, at least for the foreseeable future. Is that a reasonable sort of extraction of what you just mentioned there?
Yeah, look, I do think in the next 6 months or so, you will see the tech continue to be the leader of the market, just because of the momentum is very strong, and then the cyclical pulse for the economy have yet to pick up. So next 6 months, yes, but beyond that, you do think that valuation is quite stretched, and then you will see other businesses becoming a bit too cheap, and then earning will be in the upgrade cycle with the rate cut. That's where we do see a bit of funding out of the U.S. equities.
Okay, and Jimbe, outside of the U.S. equity market, is there anything compelling to you at the moment?
Look, in terms of the U.S. equity markets, I think, the concentration across the big tech is that, I think, NVIDIA, even though the price is very high, it is probably not many alternatives for the current AI trend to be adopted. But we do see a lot of other opportunities now forming, across other markets where, whether it's your PC makers, your adoption rate or your replacement rate should start to pick up. And these are some of the areas that hasn't really reflected in high valuation yet.
Okay, what do you think about China? I don't think China's featured in any of, at least in a major way, in any of those themes that you've lined up just now.
Yeah, look, China is interesting. Global investors has been very, very underweight China. And then early this year, or a few months ago, we are seeing a bit of a rush back into some of the companies in China, as we've seen the consumer cyclical pulse looking a little bit better. But certainly seems that the recent data, things a little bit softening again. But for a global investor portfolio, I do think there is a fair bit of interest coming back, but not in a big way yet, because the data is still very, very mixed. If anything, I think consumer space is probably where most of the interest and opportunity is. I think everywhere else within the different sectors is looking a little bit tough.
Yeah, and we started out this conversation with at some point the U.S. hopefully gets to 2%. The same hopefully could be said about China. Inflation gets to 2%, but from the opposite direction. Reason I say that is, do you think the lack of inflation in China, is that a good leading indicator, you think, of future equity market performance? Like, what would you be looking at to eventually see more flows back into this market, and positioning, which to your point has been extremely light even until now?
Yeah, I do think the Chinese market is a little bit different from other the developed markets, where retail participation in the equity market normally is pretty high. I think at the moment, because consumer confidence is still incredibly low, even though the consumer stats, the fundamental doesn't look too bad, subsequently its impact on the share market is actually quite meaningful, just lack of confidence. Even though global investor might put some money back in, still it's not in a big way. So I really do think it's concurrent that when consumer consumer is feeling a bit better in China, it will take time and it will require stabilization of the property market. Then they will feel a bit more confident to put into, the investments and then the listed investments. So, I think it's unfortunate that, a lot of those policies that's being targeted to benefit the consumer has yet to work. And it really comes down to just lack of confidence. Perhaps it's time, perhaps it's really just need that stabilization of the property market.
Junbei Liu, sorry, just very quickly, sorry, since you mentioned it. If inflation's not a problem, and correct me if I'm wrong if that's not the case, what causes the pain trade? What disturbs the peace? The VIX is lowest in what, 10, 11 years at about 12. Like, what should I be watching out for?
All right. Okay. So we're talking about global markets, yeah. So I think there's always a lot of tail risk. So geopolitical risk. We never know when it might escalate. Always creates a lot of disruption for investors. Second half of the year, we do have elections. In the U.S. election is a really big one, where investors are probably holding their breath at the moment on what the policy might look like. Generally investors don't really position for the election yet until probably August sometimes. But I would say there will be a fair bit of positioning once we get there. And then if there is any surprising policies that might create a bit of volatility in the share market.
Junbei Liu, thank you so much for joining us today. Have a great week ahead from Tribeca Investment Partners there over in Sydney. Right, so we are on the lunch break here in Hong Kong. One stock that will be trading on your right when things reopen in the afternoon session, for the afternoon session in 40 minutes or so. L'Occitane. So there's a take private offer, and there now seems to be another option on the table to minority shareholders for all, in terms of the offer for all the shares right now. So it's either $34 in cash or 10 rollover shares each. We'll see what markets make of that information. We last traded at $32.65. So it's not a change in the cash offer. It's that there's another alternative as far as that goes. That stock reopens top of the next hour. Plenty more ahead. This is Bloomberg. Right, just to get you updated now on this oil spill in Singapore, major one, of course. You have cleanup efforts are now underway at the resort island of Sentosa after the major oil spill spread to its waters. Now, it happened when you had this Netherlands flag dredger hit and then rupture a fuel vessel over the weekend. Katrina Nicholas, who leads our Asia transport coverage, is with us right now to get us up to speed here. Yeah, Katrina, what has been the impact on the beaches in Singapore?
Yeah, well, social media videos emerging over the weekend that shows thick oil really blanketing the beaches and coming up in the waves of the coastline around Singapore, particularly impacting an area of Singapore called Sentosa, which is an island off the coast. And that's a very popular resort island. It's got very popular with tourists, and the residents of Sentosa have been asked to steer clear of those areas, and many have complained about the strong smell, which can make people feel a bit nauseous and give them headaches. The Maritime and Port Authority of Singapore has said that the cargo tank that was responsible for the incident after it was impacted has been isolated and the spill has been contained, and there have been some 20 response craft deployed to clean up this spill using things like oil booms and dispersants to really try and counteract the mess. And just on your point there on tourism, that's a very good one, because this is really where, correct me if I'm wrong, there's a major casino there, there's a major theme park. Should we be looking at a potential knock-on effect to tourism and also the environment here? Well, just starting off from the environmental point of view, that is something that is supposed to have quite some impact. This is quite a large area. It's going to take some time to clean up. And that part of Singapore is home to lots of wildlife, in particular otters, monitor lizards, sea eagles who hunt for fish along that coastline. So the environmental impact is expected to be quite significant. Also tourism as well. You mentioned, Sentosa Cove is very popular with tourists. There are many beach clubs along that strip that's been affected, and we heard from one restaurant operator over the weekend who said his takings on Saturday were about $2,000, which is down from about $12,000 on any given normal weekend day. Also, Sentosa is home to very popular tourist attractions like Universal Studios, one of the integrated resorts, the big aquarium that Sentosa has there, and also Quayside Isle, which has got a lot of restaurants that are very popular as well, particularly for visitors and families. Now, they're not directly on the beach, of course, but you would have to think that people are, you know, a little bit wary going to this particular area of Singapore, perhaps because of the fumes and also the dangers that might be posed.
Katrina, thank you for getting us up to speed there. Katrina Nicholas, who leads our transport coverage out of the region, joining us today out of Sydney. Right, just ahead here on shows more on, in fact, what's taking place in Australia, but between China and Australia, and of course this big meeting that took place, and this official visit, of course, their Premier Li Qiang meeting the Prime Minister. We discuss the latest next. This is Bloomberg. Welcome back. You're watching Bloomberg Markets Asia. Just to update of markets right now. So, it's quiet because you have at least 8 markets in the region shut, although in price we're still down quite a bit, 0.7% on the region. We're pulled lower almost, I would say, almost dominantly out of Japan, where you have the Nikkei 225 now. About an hour into the afternoon session, off by give or take between the two benchmarks, 2%, let's call it even across that. We are on the lunch break here in Hong Kong. We ended the morning on slightly better footing. So in price, one stock we're tracking, of course, at the reopen in the afternoon is L'Occitane after this update here on this take private offer. One other thing I'd mention while you're looking at this on your screens is the China 10-year yield. So weak data coming out of China, weak credit numbers. You had a beat on retail sales. Property numbers continue to, I guess in some ways, underscore it's going to take some time to turn the ship around. So that's a very strong rally. We're seeing 3.5 basis points to the downside on the 10-year yield, which is something you don't normally see in terms of magnitude. So that takes the yield back to levels that we saw, I would say, back about 7 weeks or so in about late April. Right, as we head into the early part of the European morning, one to watch, of course, is how assets there fare amid the broader risk aversion in equity markets. So the European futures, as you can see, are slightly to the upside. But again, new week, but old story. Weakness coming through as well, so do expect some pressure coming through when, of course, the cash markets open up there in the bond markets in Europe. Futures on oats and also bonds continue to come under pressure early Monday in the Asia Pacific. So that's a market story for now. Let's turn it over now to this big meeting taking place, of course, in Australia, where the Prime Minister Anthony Albanese and the Chinese Premier Li Qiang have agreed to renew dialogue and strengthen the ties between the two nations. Have a look.
Without dialogue, we can't address any of the differences that arise between us. Australia and China have renewed and revitalised our engagement.
We will leverage our respective strengths to expand cooperation in energy, mining, new energy vehicles, green development, and digital economy. We agreed to provide each other with reciprocal access to 5-year and multiple entry visas for tourism, business, and visiting family members, so as to better facilitate personal exchanges.
For more on the Premier's visit, Paul Allen is with us out of Canberra to talk us through this. Paul, you've been covering this, and it's quite a rapid warming of relations between the two. So at this point in time, following that press briefing, what wins have we seen from both sides here?
Yeah, you're quite right. The warming of relations has been extraordinarily quick. It was just 3 years ago that we had a list of 14 grievances from China. And now here we are with the first visit from a Chinese premier since 2017. But yes, there was a range of arrangements that were signed by the two leaders earlier today. We had a memorandum of understanding on strengthening the free trade agreement, also an agreement to resume cooperation on the fight against climate change. And there'll be a ministerial meeting on that here in Australia Australia later on in the year. Also an MOU on education and research, and of course Chinese students coming to study in Australia, a very important source of export revenue for Australia, worth about $11 billion in 2023. So as Anthony Albanese said, there is a broad range of areas where the two countries can cooperate, but it's worth remembering there's a broad range of areas where there is still some degree of conflict. For example, there have been a number of near misses between the two militaries in the area of the South China Sea, and then there is of course the fate of the Chinese-Australian writer Yang Hengjun, who remains in detention in China on a suspended death sentence. So still plenty of areas of tension that need to be ironed out between the two countries.
And so Paul, what's next from here on?
Well, next, Premier Lee will be, well, about now, he'll be meeting the Governor-General. Then he'll be off to meet the Leader of the Opposition here in Australia, Peter Dutton. And that should be a very timely meeting because Peter Dutton, for the first time, has just overtaken Anthony Albanese in the preferred Prime Minister stake. So there's an election here in Australia in 2025, and there is a very real possibility that Peter Dutton could be the next Prime Minister. After that, Premier Lee will head over to Western Australia and Perth. There he will visit a lithium mine. He'll also visit a hydrogen project with Fortescue Future Industries. And it's also interesting that he's going there because that's where a lot of Australia's lobster fisheries take place. And of course, the live lobster export, that is the last remaining trade strike that China has against Australia. So we might even hear that that gets lifted a bit later on, David.
Paul Allen in Canberra for us and all the latest. There's more coming through here, which we'll get to it later. Of course, lots to talk about still. Right, let's stay though in geopolitics. You have South Korea says the sharing of any nuclear technology is its red line for cooperation between the North and Russia. President Vladimir Putin is set to make his first trip to North Korea in 24 years this week. South Korea's Defense Minister Shin Won-sik spoke exclusively to Bloomberg in Seoul about what he thinks Putin will get from Pyongyang.
푸틴이 원하는 건 포탄이겠죠. 미사일하고.
What Putin wants would be artillery shells and missiles. Putin is expected to seek closer security cooperation with North Korea, especially military supplies such as artillery shells that are necessary to seize a chance to win.
물품에 대해서 북한에게 요청하리라고 봅니다.
In terms of the satellite, we saw North Korea's last satellite launch fail, and that's despite Russia's pledge for cooperation, space cooperation. So what's your take on that?
그게 바로 러시아의 엔진 최신의
They are exactly Russia's latest engine technologies. So our assessment is that North Korea has admitted to receiving engine technologies from Russia. In terms of why they failed, they have yet to secure reliability as they integrate North Korean engines and other technologies that they have developed with Russian technologies. North Korea is believed to be continuing engine tests at the moment, and we believe that they will try another launch in the second half.
할 것으로 시험 발사가 아닌 발사를 할 것으로 저희들이 생각하고 있습니다.
How much North Korea is spending on launching these missiles from short range to intermediate range and ICBM? Do you have a breakdown?
Rather than speaking of the cost of individual missiles, let me give you an overall figure. North Korea fired around 30 missiles last year. According to a thorough estimate from the Korean Institute for Defense Analysis, known as KEDA, we would need some $1 billion in spending. The money is enough to cover North Korea's food shortages for a year. So in fact, North Korea is ignoring its people's hardships to carry out missile provocations.
So, Minister, Russia helping North Korea's military technology, that inevitably means greater threat for South Korea. So what is your red line in terms of Moscow's military cooperation with North Korea?
아까 말씀한
We consider the transfer of key technologies related to nuclear and missile programs as the red line, but it's something that needs to be decided together by South Korea and the U.S. There's no point in the South Korean government setting it alone, so we are having discussions to decide with the U.S. and share with like-minded countries.
We're hearing that there could be another three-way summit between South Korea, US, and Japan. So in terms of the security cooperation, what is the priority for South Korea?
우선 북핵 미사일 위협에 대응하는 데 있어서
A priority would be to establish a system to more effectively, promptly, and coherently respond to North Korea's nuclear and missile threats among South Korea, the US, and Japan, and to make that irreversible. So during the last Shangri-La dialogue, we have decided to create a security cooperation framework amongst the three of us. South Korea has drafted a document and proposed to the US and Japan. The defense ministers of the three countries will sign it in the second half of this year.
한미일 국방부장에 서명하기로 했습니다.
Minister, China has accused the US of trying to build what it calls an Asian version of NATO. So what are your thoughts on that?
중국이
On China's concerns, I think it really depends on China's behavior. If all the countries in the Indo-Pacific, not just China, adhere to the rules-based world order, the rest of the world will not try to limit it. So the idea of an Asian version of NATO to me seems like a premature concern. But at the same time, I believe that the best way to dispel such concern is for China to give the Indo-Pacific region and the international community confidence that it will uphold the rules-based international order. And there should be no problem.
지킨다고 하는 확실한 믿음과 신뢰를 인태 지역 나아가서 국제사회에 준다면 아무 문제가 없다고 생각합니다.
And that was the South Korean Defense Minister Shin Won-sik speaking with our colleague Soo-hyang Choi. Just ahead here on shows, we will be taking a closer look at this massive shopping festival. I think you have about a day left to take advantage of any deals out there. 618, of course, has been taking place for weeks. We'll dissect the numbers, tell you what we know so far and the trends that have emerged so far this year. Plenty more on that and other things. This is Bloomberg. Right, welcome back to the show. So we'll show you a couple of things here. On your left, activity numbers. On your right, the latest home price numbers coming through. Let me start, well, I think the broad brushstroke here is most actually missed estimates. In fact, a further deceleration or acceleration on sort of price declines, if you want to look at that way, month and month. So new home price is down 0.7%. We're coming off already quite a stark 0.6% month and month. So just for context, 0.6% was already the biggest drop in 10 years, so 0.7% is even more so. Used home prices also fell a further 1%. That's the home price story. On the activity numbers, so we did get a pickup in retail sales, although I'm not looking for the glass half full here. You did get some seasonal factors involved as well, right? So you had a holiday in early May, and also this weeks-long shopping festival in 618, which boosted the numbers. In fact, the National Bureau of Statistics even sort of underscores the two of those factors. Now, broadly, they've also said that the effective demand remains inefficient, or insufficient, rather, in the Chinese economy, which might be, I guess, in some ways an orientation of where policy direction is probably headed. Now, more on that last bit I just mentioned, the 618 holiday. So it's about a month long. It wraps up on Tuesday. It's a festival invented by JD.com. It's a key test, of course, for e-commerce platforms. And our China correspondent, Min Lo, looks at how companies are convincing Chinese consumers to part with their money.
Rihanna making Shandong crepes. Apple offering its biggest ever iPhone discount. And an AI-powered avatar of JD.com founder, billionaire Richard Liu. All in hopes of standing out and getting consumers to spend. Similar to the Double 11 shopping holiday invented by Alibaba, 618 is JD.com's version of a month-long discount spree ending on June 18th. This battle for the consumer dollar has taken a hit in recent years as the slowing economy has turned Chinese consumers into more selective shoppers, making the price point for products even more of a focus.
Consumers are still buying. They're buying cheaper things. The average ticket size is coming down.
They are still going with some of the low price strategy out there.
Smaller companies are now competing in the same space thanks to China's anti-monopoly investigation into Alibaba in 2020. Douyin, Kuaishou, and Little Red Book have joined in the e-commerce game, Douyin leading the charge with 70% growth in GMV year-on-year. Alibaba and JD.com trailing behind in single-digit growth. The smaller upstarts have forced Alibaba to rethink strategy, founder Jack Ma calling on employees to think outside the box. The result, a partnership with ByteDance's own Douyin, allowing merchants to advertise on the video platform and make transactions on Taobao. But even with the intense competition, consumer spending still cooled in recent months, and the platforms are hoping to reverse that during these key shopping holidays. Min Min Lo, Bloomberg News.
And Min Min, in fact, joins us now for an update on another story actually we're tracking, which probably affects Chinese consumers as well. So you have Walt Disney's Deadpool and Wolverine set to be cleared by Chinese regulators for release in that lucrative market. That's according to people familiar with what's going on. Potentially a huge deal here. In a very big market, of course.
Yeah, it's a big deal because China is a very lucrative market. If you remember when in 2022 when Avatar was released in China, that really pushed up the film to be the third highest grossing movie in history. It's a breakthrough for Disney because the first Deadpool was banned because of graphic content. The second one only got a PG-13 release. And we're hearing that this third one is not going to see any major cuts, which is good news. And it's a win-win, basically. I mean, it's good for Chinese consumption when consumer demand remains quite tepid. It's good for box office revenue. It's good for Disney as well.
Yeah. Could it be, should we read this as another sign that maybe this is headed in terms of a thawing in relations between, or am I reading too much into this?
Yeah, I don't know. I think we could be reading too much into it. I'm not sure because I mean, ultimately, the movie industry is still a very small sliver of U.S.-China relations, and there's all these very intractable security issues. Certainly, in the past, China has tightened regulatory approvals when relations are bad, but they've also been doing that as the domestic film industry catches up. I think last year, we are seeing domestic films make up over 80% of market share, and China has in the past also banned, I think, at least 7 Marvel movies, citing reasons from having LGBTQ content to depictions of international newspapers that are opposed to the Chinese Communist Party. But the good news is I think they have approved about 5 out of 6 of the recent Marvel releases, including the current one. But it's hard to say if this is politically driven or if it's part of a definitive trend of stabilization of relations.
Well, at least coming to a theater near you, at least as far as these two things go. And to be honest, you know, some of the Marvel movies were not really that good. That's a personal opinion, so they might have not missed a lot. Min Min Lo, thank you so much. Our China correspondent there. All right, banter aside, lighten up. It's Monday. Plenty more ahead. This is Bloomberg. Right, welcome back to shows here. So, interesting trend that we've seen in Chinese markets. So we know the onshore market has underperformed for 4 weeks. This is a Monday, so we could be going for 5 weeks now. Well, let's see what happens this week. It's very early. Of note, though, within that market, and perhaps the reason the CSI 300 has underperformed, its biggest stock by weighting, Maotai, is down about 11% over the last month. It's down about 13-40% from the peak when you draw that all the way back to somewhat earlier in mid-May. And this might actually constitute really just a good example of this story that we're tracking today. Really, the economic slowdown has turned these mighty shoppers into reluctant spenders, right? These are some of the premium brands underperforming, and the shift is particularly painful for these stocks that we're showing on your screens. Jeannie Yu, our Asia Stocks reporter, is here with us to talk us through what exactly is going on. And can we draw a direct line between the economic weakness and the underperformance of these stocks here on our right?
I would really think so because, you know, if you look at underperformance, it's quite sharp because, like, for example, like in the MSCI space, like since May peak, I think half of the MSCI discretionary gauge, the biggest underperformer were all from China. So there were Porsche, you know, the Porsche dealer like Zhongshan Group, and we also saw Maotai there, and then we also see, for example, the Nike's OEM producer, top sports.
Yep.
So there are a lot of those names, which have been very big underperformers. I think it's one of the reasons why, why that's a sign that traders are really, I'm not saying they're dumping, but at least they're avoiding those shares. Like even when we see, the broader market has actually staged a very quite meaningful rebound. So I guess also going forward, so this morning we saw retail sales actually beat estimates, but I would think for these shares to really come back, traders would really need more evidence. Like for example, for Multi, I think they've been lowering both the wholesale and retail sales prices throughout this year. So according to Goldman Sachs reports and also some channel checks by some other analysts, so they didn't manage to hold their price hikes they announced surprisingly last November. So which is a proxy of China's luxury consumer spending appetite. So I think that tells us a lot about the trend.
We're showing it on the screens. It's not just the local brands. Like Budweiser APAC is bottom of the screens right now, down 60%. So this sort of envelopes foreign brands as well that are just happen to have the same margins and sort of sector dispersion. Yeah.
Yes, so we did the story about, how the foreign brands like Dior, and Kering, how those European luxury brands, they've been suffering from the China economic slowdown, the consumption, weak appetite. I think this one is spreading more widely, even, to some smaller category like beers. They don't want to buy Budweiser, which is in the premium category. They may doing some consumption downgrade, and it's also one of the reasons why we see PDD rally so much over the past 2 years, because they've been doing so well, in the lower tier product categories. So I think this kind of contrast is going to continue in the China stock market, even when traders start to do some bargain hunting after the recent decline.
Jeannie Yu, thank you so much, our Asia Stocks reporter there. You can check out that story on your Bloomberg and also on the website. Right, some other top geopolitical stories that we're tracking at this point. So China's Coast Guard says Chinese and Philippine vessels have collided near the disputed Spratly Islands in the South China Sea. Now, a statement on WeChat says the Philippine supply ship ignored China's repeated warnings and behaved in an unprofessional manner, resulting in a collision. Now, it's the latest in several recent clashes in the area, which the Philippines says falls within its international recognized exclusive zone. The Filipinos gathered in the protest outside the Chinese consulate, this is on Friday, to denounce Beijing's trespass rules in the disputed waters. Now, the Israel military is starting a daily 11-hour tactical pause along a route to in southern Gaza to increase humanitarian aid. The army says that the pause is in effect until further notice and is being coordinated with UN and international aid agencies. Now, the pause comes weeks after the world courts ordered Israel to immediately halt its military assault on the southern Gaza city of Rafah. We'll leave that story there for now, but certainly keep on top of that story. Just a reminder, too, just to pivot back to markets, just for our viewers here, that a broad part of the equity markets in the region are closed. At least 8, as you can see on your screens, are shut in the equity markets today. So when you are down in price, we're down also about 40% on volume, 30 to 40% more than usual. That being said, though, watch things very closely, particularly in Europe as we go into the session there. Bund futures are still down. Oat futures are also still down. Equity markets are still pointing up, so we'll see what happens here. As far as the currency is concerned, I'll leave you with a look at the euro and its key pairs there as well. Steady after the worst week since April. That's it from us here in Bloomberg Markets Asia. Plenty more ahead. Daybreak Europe is next. This is Bloomberg.